these are great long-term markets, but you do have to have that long-term bias to them. You've got to sit through the cycles.
Totally.
And you need robust founders.
So Dave, thank you so much for being here and giving us your time. And
thanks for having me.
Yeah, and for our listeners today, it would be great if you could just explain, who is Dave? Who are you? What do you do? Where do you come from? Just a little bit of a background would be fantastic.
No, super. Let's kick off there. And look, thanks for having me, Gaurav. Big fan of what you guys are doing on the pod for the region and the community. So it's great to be here with you and your and the people watching. But I'm Dave Nangle. I run VEF. Let's get straight into professional. I run VEF, listed investment company, listed in Sweden. We're a permanent capital vehicle. We can get into that, the nature of it. But what do? We invest in fintech across emerging markets. We set this company up back in 2015 with simple ideology that there's a lot of value creation in the structural growth trend in fintech across the fast growth emerging world. Not a lot of capital was focusing on the opportunity at that point. So we set up the vehicle in tandem with some of the biggest investors in the world who are looking to access these trends and put capital to work. So some of our capital providers include, funds like Fidelity, Wellington, big global institutions that are looking to, basically access the fast growth private space and get their foot in the door pre-IPO. So we set up the vehicle for them for that. And that's nearly 7 years ago now. And we've been doing it through that period, which has been a great window for venture investing until maybe the last 6 to 12 months, which has been a bit spicy. And we've made over 20 investments. We've had some great exits with some great IRRs across some, strong, big growth emerging markets. We're a team of 11 across 3 countries today, Europe-based, but we travel for a living. I myself am Irish. I'm based in Dublin. That's where I'm talking to you from. But that's me. That's VEF, and that's where we're coming from.
Great. I mean, before we dive further into, say, the dynamics of what makes up VEF and what you've achieved and what you just described to us about when you had started and what you're looking at doing and the investors you have, before going into that, I'd like to maybe get a little bit more on your background before you start that. I believe you were with RenCap in Moscow.
Yes.
And so if you could tell us about that background you had, what is RenCap, where you started, and then why you went from there into VEF and emerging markets today. Could you take us through that?
No, for sure. Let's do a little bit of, origin story. Let's even go back in my history for anybody that's interested. But, I went to London to work in investment banking, as many people did from around the world. Streets were paved with gold. Go over there and make your money and you become a hero. But I ended up in Barings Bank. ING took it over in the emerging market team, equities. I love the idea of covering equities. You had your finger in financial services, but you're also in the real world of equities, real companies, something tangible. And then put in the emerging market team, which is more by luck than by design, and covering financial services. And I did that for 6 years in London. But effectively, I was an Irish guy sitting on a desk in London, traveling to places like Poland, Egypt, Russia, Brazil, kind of tourist emerging market. I had no stripes or credentials. And I was surrounded by, people like yourself. I was surrounded by Poles and Turks and Brazilians and Indians who, were living in London, but covering their home markets where they were born and bred, and, basically understood the history, the politics, the culture. So I very much wanted to go and work and live in emerging markets and earn my stripes because I was fascinated. And Russia came calling. It was a good time for Russia. Not so much a good time anymore, but at that time, Russia was on song. Oil price was high and rising. Putin was relatively new, relatively good, all relative. And the investment banks there were looking for talent, foreign talent. So I went to work for RenCap, Renaissance Capital, which at the time was the number one, even though everybody says they're the number one, but at the time was the number one domestic investment bank, but like EFG in your region, but for Russia and the CIS. And it was a fascinating time to go. I was there for 5 or 6 years. I went there to cover, like Ronit, Ghose, I was a banks analyst. I went there to cover one bank, which was Sberbank, the biggest bank in Russia. But the ideology was that we would list or work on the IPOs of the rest of the Russian banking system, which we did on a large bunch of state and private banks. And then from Russia, we went to the former CIS, Ukraine, Kazakhstan, Georgia, covering banks, IPOing banks. We leapfrogged into Africa.
Oh, wow.
where I was covering Nigerian banks, Kenyan, did IPOs in Rwanda. Then within the group, we did a bit of private equity. I was doing private equity in Togo and financial services. And then as a group, we got to, it kept on expanding. I was covering Turkish banks, etc. But, I guess as a career choice for adventure, for, opening your mind, education, experience across many different emerging and frontier markets and types at different stages of their cycle, for somebody looking at banks and financial services from, I guess, a history of branch-based and cash-based banking through to digital, through the lens of emerging and frontier markets, which is totally different through the lens of developed markets. That was a phenomenal career for me, and it was never dull. You go into a career, and some careers after a couple of years, you're spent, you want to do something different. But Renaissance Capital was ever moving, ever changing. And I was always about to rise to the sun or fall off a cliff. It was always on a beautiful knife edge, which kept us, kept you on your toes. But from there, I'm sorry, I guess the question was, how does that transition into VEF? Without talking too much about myself, is, I guess, having seen the financial services world and the evolution of it through my role at Renaissance Capital, and names like Tinkoff Bank in Russia, the digital bank, or Alior Bank in Poland, which I worked on the IPO, or running around Africa looking at M-Pesa, you could see where financial services was evolving. At the same time, I was lucky enough to be spending more time with entrepreneurs and VCs at an early stage. And I knew that's where I wanted to transition my career from the Renaissance side of things, no disrespect to that company. And then I was lucky enough to partner with a guy called Per Brilliot in Sweden. He ran an investment company, a listed investment company called VNV. And he asked me to come on board and create a separate vehicle for me and Fintech. So it was kind of my ideology of wanting to do this, him looking for a partner to come in and work with him and separate his company into two different pockets. And that kind of meeting of minds back in 2015 came together to create a vehicle to invest in Fintech across emerging markets at a great point in the cycle.
Oh, wow. So VEF is essentially your co-creation, if I can say it like that, correct?
You can, and it's, without getting too ahead of ourselves, the nice thing is you are a founder. You're a founder of a company investing in founders. And we build our own company. We've got three aspects to what we do. We always talk about it at VEF, that we've got, the capital side, the funding. You got to love the money, because the money is what keeps you going. You got the investment side, which is our portfolio companies in the pipeline, which is a machine we're building it all the time. And then you got the business. We're not a fund, we're an investment company. We're building this for the long term. And we have aspirations. Some would say aspirations of grandeur, but we look at Naspers and Prosus, we look at Berkshire Hathaway, the big round. In Sweden, there's Kinnevik. There's big, long-standing 10, 20, 50, 100 years investment companies. We're around for 7 years and still building our track record, and that's the kind of path we want to go on.
That's very interesting, because when you talk about an approach of a fund and you say we're not a fund, we're an investment company, and that your track record is 7 years and going, can you tell us about how you differ from a traditional fund? Yeah, no, it's key. I think we are venture capital in mindset, so we are private equity in mindset, and there's a little bit of high risk, high reward.
Exactly, but we're investors. But the vehicle itself is a permanent capital vehicle. It's not a time duration vehicle of 5, 7, or 10 years where we take money off investors, or we get commitments from investors, we draw down as we find investments, and then as we exit, we pay back. The way a listed investment or permanent capital vehicle works is that we raise cash into the vehicle day one, and then we put that capital to work. And as those companies grow, we have an NAV, which broadly reflects the value of an inline portfolio. And there's a share price, which trades in tandem with that at a premium or discount as we go. But with this permanent capital vehicle, as we exit positions, as we did with Tinkoff in the past and with EasyCo in Turkey, the capital goes back into our vehicle, and that's capital to reinvest then in new assets. And if we run out of money or going low on capital, we can always go back to the market and raise capital from the market via capital issues, private placements or rights issues. At the same time, we can buy back our own shares that are trading at a discount, and we can return capital to shareholders via dividends or buybacks. So it's kind of a permanency of capital, different vehicle, and it allows us to track capital from certain pockets, which the general VC world doesn't go to. We go to public market investors. And I guess the key difference, though, besides all the technical stuff, which is a little bit dull, the more interesting thing is that our capital is permanent. So when we go and meet a company, and we've met many companies in Middle East like Hasna and NowPay and people like that, one of our key selling points is we have permanent capital, we have forever money. Your story, most stories that we look at are not 5-year clean stories in and out. If they're going to be successful, they're going to be 10, 15, 20 years, could be beyond. And our capital can go the distance with them. At the same time, the capital behind us, we've got our pockets, but behind us are deeper pockets like Fidelity, Wellington, Principal, Robeco. And these guys have in the past invested in our companies in later stage rounds when you get to pre-IPO. So you've got the capital up front, you've got the wall of capital behind, and that also helps companies get towards IPOs. So we're kind of a great vehicle for that.
So I guess flexibility in your offering, not only for the companies you're looking to invest in or engage with, is one key element, because like you said, you can go back and raise further funds from your existing pool, but also you're looking to protect capital for your investors. I guess you could liquidate. I mean, I've seen similar models work, but I imagine the amount of work that you have to do internally to keep up to date with data is a tremendous job. So how big is the team that works for you, just crunching numbers all the time and keeping track of what's happening in market trends? It must be quite a lot, because if I look at how venture capital funds work, they invest in a founder, a team, and a thesis. And because they're locked in effectively, not looking to sell their positions off, they're looking to maintain their percentage positions and essentially drive to an exit and then recoup funding. You're not looking at doing that. So I guess it's kind of like a hot potato. So is there a big team? I mean, how do you do that internally in the process of assessing?
I'll answer your direct question, and then there's an indirect point that's kind of coming through as well. I think on the indirect side is the incentive structure for somebody like us versus a classic VC to invest is totally different. So, if you raise, if us two set up a VC fund and raise $100 million from a bunch of investors that we could draw down, we'd have just marketed to them the dream of, tractors in India, and we were going to put a lot of capital to work in that. And we'd feel the positive pressure to put that money to work. And we also wouldn't get paid until we did put that money to work. So there's always been a rush of capital to be deployed to raise more capital. With us, we can actually not invest and make money for our investors or lose them less money in a way. We're incentivized always on NAV per share and share price. We're incentivized to make great investments. We're basically incentivized to make a return on capital for our shareholders and not to deploy capital as much or as quickly as possible. And we can do 10 deals this year and deploy as much money as we have, or we could do no deals this year and we don't feel pressure either way. So there's always, there's a better kind of true cycle feeling for what we have. But when it comes down to the team, we've kind of evolved over time, Gaurav. We started back in 2015. It was myself, it was Alexis Koumoudos, who's our CIO sitting in London. And we built the team around us too, effectively, with our CFO and our chief legal, now ESG, in Sweden. But today we're 11 people. The investment team has 7 based in Dublin and London. And it's a big world, emerging markets, but we're very focused. And we spend a lot of time, we'll talk about this, in Brazil, India. There are 2 key markets. So, we're not a Brazil or India fund, but they get a lot of our time, our attention, and we go there a lot, 3-4 times a year. We know all the VC partners on the ground. We've co-invested with them. We crunch the numbers. We meet the opportunities on the ground. So a lot of time spent on those 2, followed by areas like Mexico. Indonesia is getting a lot of focus, and then some of the frontiers, which we'll talk about. So it's a 7-person investment team, and there's a real process behind it. We are very, I'm a former head of research. I'm a former banks analyst. The team around us we're data people, we're analysts, we're markets people. We're not a founders fund, so we don't come in with the founders backdrop. We come in with a little bit colder, the analytical markets backdrop, but it served us well, and it serves us well where we play in a kind of cycle which is more growth stage and earlier stage on average.
I have to say, I'm extremely jealous, because you get to do something full time in this space that I love, which is emerging markets. So we could talk about emerging markets all day long, but before we do, the first thing I'm going to do is I'm going to call out my co-host and partner in Fintech crime, Mr. Ronit. Welcome back, brother. We missed you.
Hello. I've arrived to sort of reduce the quality and the tone of the conversation, and also to add some color to this very, very white shirted. I didn't get the memo. There was a dress code.
Did not get the dress memo on it. What's going on?
You need to read your emails, Ronit. But before I hand back to my glorious co-host, Dave, one other question I have to ask you is, since you're focusing in emerging markets, I've got a few names of a few funds that I think are doing exceptionally well out there. Big shout out to Clock Tower, Kona, Antler, these sorts of people that doing fun stuff out there.
Yeah.
But what are your favorite companies that you've personally sort of gone and grabbed and have been with and trying to help grow in your portfolio so far before Ronit takes over and gets to more intelligent questions?
We'd be lucky. But it's look, our favorite companies. Look, it's hard not for your winners to be your favorites. It just but it's different with my kids. You love them all equally, but with my portfolio companies, the winners are your favorites. But look, we've been in and out of EasyCo in Turkey, an online payments company. And this is a couple of Germanic Turks, Barbaros and Tassin, who built a phenomenal company. It was a joy to be with them. So structured, organized, diligent, focused. And it was I almost, we were turning up every quarter for board meetings in Istanbul, and it was almost like a victory lap. You turn up, you sit there, you go, I'm pretty not needed here, and then you go back home after a nice dinner. And there's nothing wrong with that. There's times when the VCs add a lot of value, and there's times when VCs should keep their mouth shut and enjoy the ride. And that was definitely one. I enjoyed that from start to finish. And we made a lot of money. We sold the business to Naspers, and everybody was happy. It was a win-win.
Wow.
I think, besides founders wise, I can't not mention Sergio Furio at Creditas, which is our biggest asset today. This man is a machine. I'm very happy to back him. I wouldn't want to be too near him for too long. He's exhausting, but I've never seen anybody turn, basically concept into reality, into revenues in such short cycles. There's generally companies talk about an idea, then they have a pilot, then it's just moving on. And then maybe 2 or 3 years later, you see $1 revenue and it's probably a negative IRR. The iterations are 3 or 6 months with this guy, and it's phenomenal what he does. And I guess last shout out is someone you've had on your pod, is Omer Ansari from Abbey.
Don't give him airtime. Come on. Come on, not that guy. Come on, anyone but that guy. Let's not talk about him.
Now look, he is someone I've been lucky enough to work with in the past at Renaissance Capital. And like, he's somebody we sent to Nigeria. He joined us and said, go to Lagos. He goes, okay. And he turned up in Lagos, and he built a franchise for us in Nigeria. He went to South Africa, East Africa. He's somebody who's as comfortable in the upper echelons hanging out with politicians and capital providers as he is hustling on the streets. So I love that range that he has, and he's got a massive fear of failure as well, which always has him on the edge.
Ronit, we're going to delete this part of the episode. I'm telling you now. It might be live for everyone who's lucky to listen to it. But Umair, I love you, bro, but I'm going to cut this out. I'm just joking. No, big shout out to Umair as well. He is someone who can deliver really strongly. And unfortunately, I joke because I know him in a personal capacity before I came on as well. So I'm on that boat with you, my friend. So yeah.
There's actually a fun story about Omer on this podcast, because he came on this podcast a few months ago, I think. Remember? And I think he was one of the first people our friends at CFTE then put on TikTok. And the fun story is that Omer, until recently, and maybe even now, is far too serious a person to be on social media, specific things like TikTok. His twerking ain't that good, let's just put it that way. And he got put on TikTok, and it was one of our most watched episodes. That video there was a side of TikTok that's really dying for fintech content. Who knew?
There you go.
Who knew? Who knew, Dave?
Thank you so much.
There's an investor relations opportunity for you, Dave.
Really? Yeah.
And on that high note or low note, we'll decide later. Back to you, Ronit. Please take over.
Absolutely. Absolutely. We're gonna pivot from talking about TikTok as an IR strategy for Dave to talking about his Latin love story. When I first met Dave, story, Mrs. Dave, if you're listening to this, we're talking about his investment love story. When I first met Dave 6 or 7 years ago, he was all about Russia and Eastern Europe. He'd spent a lot of time in Russia. I think Vostok had a big connection to Russia. I don't know if you're going to give a shout out to your first very big investment. That was an amazing company. Obviously, lots of things have happened in Russia since. But talk about that pivot or that journey from going to, living in Moscow, being really deep into Eastern Europe, and then falling completely in love with Latin America, particularly Brazil.
Yeah, no, all fair. So look, when we set up in 2015, we were called Vostok, since being changed to VEF. Our biggest holding was Tinkoff Bank, digital bank in Russia, which did exceptionally well for us. We turned $25 million into 125 and 60% IRRs, and a great journey for us and the best digital bank in the emerging world until it wasn't. Well, probably still is, but just isn't listed properly. But just through our analysis of the region I knew very well. Like phase one was we were in Tinkoff, the number one fintech asset in Russia. I think everybody can agree on that. We then moved to other parts of the region, which was like Turkey. We got into EasyCo, the number one fintech in that country. Then got into Africa, which I knew well with Jumo. So we had a very good track record of finding and getting our capital into some of the best fintech companies in the EMEA or East European region, as you allude to, Ronit. But through our initial 1 or 2 years of work there, it was a very shallow region in terms of opportunity set. Russia for one, Turkey for another, two big markets. Middle East was only getting going. Middle East is obviously a bunch of smaller countries, maybe Egypt and Saudi today, which we can get onto. And Africa was still super early stage. So we started to lean out. We had an emerging market mandate and we hit India. And we ran around India for a couple of years, got spat out by valuations and an aggressive local ecosystem, but it's much better today. We've got a much better India story as of now. But then we found Brazil. And I've said this a few times, it's paradise for fintech investors. Not paradise for every kind of investor, but for fintech, we just found a country that was scale, 200 million people, that had an incumbent oligopoly of a banking system, like they all do, but with supernatural unit economics. Those margins are still there today. The interest rate spreads, the payment terms, the fees on mutual funds. It's a big digital market with high unit economics, high revenue economics. You can make money. You don't need to J-curve businesses. You can have profits. That's possible in Brazil. We had a regulator that was super supportive and an ecosystem that was vibrant. So good local funds that were doing seed and Series A, but not a lot of capital coming in thereafter for the growth stage. So we kind of turned up at a good time, lucky or good, back in 2016, 2017. And we started to put capital to work. And it was one of those things where the more capital you put to work, the deeper your relationships get. You get a good start in life in a country. One investment becomes two, becomes four. Today we've got six. And we're deep in that market. We've had good success. Creditas, obviously our benchmark name, but even the 2 deals this year in Sol Facil, in solar, Gringo, in a car app. And it's been very good for us. It's become a benchmark market for us. And I guess the other thing is we exited markets like Turkey and Russia, which are not natural, easy exit markets through cycle, M&A or IPO. Brazil is quite a robust exit market. We love entering investments and we've got permanent long-term capital, but we do like exiting investments as well. And Brazil gives you a good true cycle market for that.
Brazil, so there's an industrial sector, which is big profit margins, large TAM, large population, good entrepreneurs as well. And then there's this kind of financial side as well, that is the exit opportunities. And could you spend a little bit more time on that? Because maybe sometimes that gets missed by, folks who are not deep in this like you are. Because that's the big challenge in emerging markets, whether you're in public markets or particularly in private markets. Getting there is maybe difficult, but not the hardest bit. It's getting out. And
it is.
You can get out of Brazil and make money.
No,
with your circulates of cash. How does that work?
Yeah, I think like a little bit of my history in Russia, there's an element of, get out when you can, not when you want. So if you have a great asset and there is a bid on the table, even though it mightn't be exactly what you want, the window has arisen and hit the bid. So I don't tend to be overly greedy in EM when I have a winner in a good place with a good return. If the window arises to exit, you take it on average. Now, it's on average. Brazil is a little bit different. And obviously there's points in the cycle, good and bad, but through cycle, Brazil has seen the IPOs of Pags and Stone in the payment space. Both fintechs, we've seen XP in the investment space, we've seen Nubank in the digital banking space. There's been a number of others, smaller tier fintech companies, and there's been a myriad of M&A on the go behind that. So we've exited 2 companies in Brazil. Now, they haven't been successful, but there have been exits through M&A. So there's always that bid going on in the M&A consolidation market where things happen. So, we haven't seen that in emerging markets across the board. India, we've seen a couple of IPOs happening, Paytm and Policy Bazaar, a bit of M&A in the background. And then across other emerging markets, it's just hard. Like, we're in Pakistan, we're making early bets there, but that's for the long term. Africa hasn't had a whole raft of successful M&A or IPOs. So Brazil stands out in that regard, and we like it.
And talking about Pakistan, while we were chatting, Dave, a VC who's listening to this just messaged me, just DM me saying that that TikTok reference and Omer, it's been forwarded to Omer already. So you'll have to edit this out very, very fast, Gaurav, because it's already out there. I'm not going to mention their name, but a Pakistani VC has DM'd me saying they were listening to that. That's a great pivot, hopefully, to talking more about MENA, the region that Gaurav is based in, and I'm normally doing this podcast from. MENA and Africa. You're obviously, it's public knowledge, you've invested in a few names in the region in recent years. But Dave, you were, like many people, cautious, if I can say 5-6 years ago. Latin America looked more exciting. Russia was kind of roots, but what has it changed your view, or is it still a very long-term pipeline? Because it kind of, my view is, it kind of got a little bit exciting, maybe even almost frothy in Africa, particularly in Nigeria. Pakistan, still a great, like people, there are others, not just Omer, some great founders, some really super smart, whip smart people, but things are looking pretty tough from a macro perspective in many of these countries again. And we'll talk about the global capital cycle in a second, but the local macro cycle, that's been tough for a while, and it's kind of some of the more ugly things are coming out again. How do you see the region? And it's a massive part of the world, but we have to ask this question because Gaurav and I are sort of based in the region. So, and don't sugarcoat it.
I never do. Now, look, what I'd say is you can't be fixed with your view. You got to be open, and you got to keep on evolving. So my view keeps on changing. I never Egypt good, Pakistan bad, and I hold that for 100 years. There's nothing like that. I also love the fact that there's macro, and then there's what we're investing in, which is structural growth stories over time. So, whether it is Nubank in Brazil, to grab an example, or Bcash in Bangladesh, or let's say Fowry in Egypt, how many cycles have each of those countries gone through as these companies have successfully built and created a lot of value for the early stage private investors over time. So, we're openly investing in all of these countries with a view that we're going to go through a few bumpy cycles, and then there's pros and cons to those bumpy cycles, whereby in a cycle like this in Pakistan or say Egypt, which are at the cold face of macro, political, geopolitical, currency issues, those companies that are well funded, and standing strong can actually build phenomenal businesses at a time when not a lot more capital is going into their competitive peers. So there's pros and cons to that, but also these cycles can kill you. That's the downside risk. So I guess we're in Pakistan, and Pakistan is is one of those countries that's from a macro point of view, the balance of payments, the currency, the deficits, a bit like Egypt, a bit like Ghana. There's a bunch of them around the world at the cold face of the stress. But we're investing in Abbey, and Abbey's just raised a ton of hard currency funding, which is sitting offshore in a very nice place, and becoming more valuable on a local currency basis by the day. So the best thing Omer can do is keep that money in US treasuries and watch, and we're all making money or losing less money. But he's well positioned to build a business with that hard currency, in a market where that won't get a lot of incremental size funding in the near future. And he knew going there to build this business that it would come with, these kind of cycles. So honestly, we and just from a capital investment point of view as well, I was part of me was happy last year because we were all making money on paper. But part of me was unhappy because the tourist capital, not to be too unfair, there's a lot of global capital was finding its way into places that it shouldn't. And that was putting up the price of a lot of things, and it was meaning a lot of average founders were being backed when they shouldn't, not to name names, and that's just opinions. But, we're getting back to a more realistic, more fundamental, more focused market. And we won't see tourists in Pakistan this year, no bad thing. And some of the capital for mid-growth stage in Brazil is disappearing. I like that. So these are good things for true cycle permanent capital with a focused nature.
No, the point, and we don't want to be derogatory about anyone. You need all of these capital providers, but that tourist capital point is, I think, for all of us in this conversation who've looked at emerging markets for a long time, can be very irritating. The number of friends of ours who'll pop up and say XYZ country in Africa is the next Brazil, or Pakistan's the next Indonesia, and you're like, whoa, can we just slow down? I know it's got 200 million people, but it's not the next Brazil. Still could be super exciting.
People need to go to Lagos. They need to go to Karachi. It's pretty real. You don't come back from there going, oh, I really want to invest. It's not the natural tendency. You come back and go, I don't want to go back. That's the first instinct.
I don't know. When I went to Lagos in 2019, I went back 3 weeks later. The guy at immigration recognized me. Go back. True story. I'm not making this up. But
these are great long-term markets, but you do have to have that long-term bias to them. You've got to sit through the cycles.
Totally.
And you need robust founders.
And tied to that, I want to sort of make this into more of a global cycle point, because we've obviously seen in public markets since probably the middle of last year, since about Q3, that multi-year narrative, which was tech good, everything else bad or boring, begin to disintegrate. You had a multi-year, it was almost decade-long cycle, which then got hyper-charged during the COVID period because of Fed policies. And that cycle began to turn in Q3 in public markets, and in private markets, obviously there's a time lag, and it's been turning this year. We're still having these discussions around emerging markets, but particularly the smaller ones in a global context, like the Africas, the Middle East, because the structural story is so good, right? I mean, and also longer term, you're building real value in the sense of you're bringing people into, people who don't have access to proper credit, or, have really, it's not just high interest rates like in Brazil, it's just as simply access isn't there. And so the social story is fantastic. And there's a profit margin story as well, because, the ROAs can be pretty good in these countries, such as Nigeria or in Egypt. But the cycle has turned. Who knows if it's coming back soon? I mean, there's a short-term bounce we've had in the public markets the last 6 weeks. So the newspapers are now writing about the bull market's back. But the cycle turned. And what's your view? I mean, you're very experienced, both public initially and now private market investor. What's your view in terms of where are we in this cycle?
Okay.
And particularly EM. And if you can talk about MENA in that context.
Yeah. Look, I think, first of all, we're paid to invest in emerging market countries and companies for the long term. So it's in mandates through cycle. But the flip side of that is we're not, running out to put capital to work right now. And why not? Because we're cautious. Because, who are we to call the global cycle, US inflation peaking, US interest rates, which will have a knock-on effect, a very aggressive knock-on effect for the rest of the world, with the emerging market and the frontiers being at the higher beta end of that. So there's a lot of uncertainty and moving parts, whether it's in global macro rates, inflation, into global geopolitics, which can affect our countries fundamentally or capital provision to our countries and then the companies within it. So I guess what we've done as a company, first and foremost, we've got our own shop in order, our own balance sheet in order. We raised the bonds and ESG bonds earlier this year. So we're sitting, long $60 million of capital. We're making sure that all of our companies are, well funded. We want, our biggest and best companies are well funded on a high growth path to break even at this point. And that's the kind of golden trilogy we're looking for from our companies, because maybe we can't rely on the markets to give them more capital in the next 6, 18 months, 3 years. Who am I to call it? But one needs to be ready for these kind of movements. But then within that, you pull it back to the Middle East. The Middle East is quite a unique region in many ways, as in it's the amount of capital in that region and the growing amount of capital in that region is phenomenal. The Middle East is probably, and there's various pockets within the Middle East and various entities, but is as best placed anywhere to continue to gather capital and deploy capital through a window of distressed asset prices, and can actually create a lot of value for the region over time. And a lot of that money, may indeed go back into the region. And Saudi is obviously a great example of that. So I think MENA, from just being long capital and getting longer capital by the second, is phenomenally well placed. And if they do channel that into the startup community, which they have done, and there's great VCs in your region, like hats off to Beko and what they've done over time, and Amir Fah, who's left Beko, starting his own thing. These are people I've got a lot of respect for, early pioneers, and made real returns for investors. If that capital can be channeled through entities like them and back into the region, it bodes well. How do we see MENA in general? We've done a lot of work in Egypt over time. We haven't made any bets yet, but I've got a lot of respect for Hasna, the guys at that team, and Paymal we got very close to. Some great companies coming out of Egypt. We like the scale nature of that market. The broader Middle East, a bit smaller in nature and market size. Saudi's now becoming interesting. Africa is a different beast altogether. I think Africa has the risk of falling off piste for a bit. It's one of those regions that can get very hot and then in 5 years disappear and then get very hot again. But that abyss can hurt. And Africa obviously isn't just one country, it's 54 countries. And within that, people tend to focus on Nigeria, maybe Kenya, and one or two in between if Ghana gets a look. So I'd probably see Africa at more risk in a, capital light market like this than maybe Middle East for venture investing and fintech companies.
And we're coming up to sort of the end of this podcast. So maybe just a quick wrap up, Dave. If people are listening to this on whatever podcast channel of their choice, and they want to find out more about you and VEF and your portfolio and all your great, how do they do that?
Yeah, look, we are a listed entity, so we're public, very transparent. VEF.VC is the website. We've all our quarterly reports on there. We're covered by some big investment banks with research out there. Our stock is traded in Sweden under the ticker VEFAB, VEFAB. And what's, the pitch for us, besides the longer term, you get access to some of the best emerging market fintech companies through the prism of our share, is that we have repriced like a public market stock. So we're trading like a public market stock at a discount to NAV, and NAV we stand behind. But you're getting access to those private companies which haven't yet repriced, in the private markets. So it's a long-term investment play plus also a value play at this point in time.
And your investor base, and I know a lot of this information is public, but how do sort of your investor base look at you? In Sweden this exists, and in many other parts of the world the structure doesn't exist. So
yeah. Look, generally it's been a positive for the people who have supported us, because we've given them access to the space that they couldn't have access to. So when we're with the guys at Fidelity, Wellington, Principal, Bailey, Gifford, Robeco, the list is going on and growing, Wasatch, which is great. And it's obviously down to track record over time. They're public market investors. So they're investing in Banco de Brazil and PKO BP and OTP and I don't know, Bank Riyadh and whatever the listed banks in the local markets. And that's their access points. Until recently, you got some more fintech companies listed in emerging markets, but it's been quite light. So we gave them a unique access points to that fast growth space. They use us, ideally to make a return on capital, which was working until 2022. They also use this as a research input where we talk to them. We sit down, we discuss publics versus private. So there's a great mind share. We benefit from them. They benefit from us, I think. And more recently, they've started to invest in some of our later stage companies, putting capital to work in names like Creditas in Brazil or Jumo in Africa. So it's been a great playbook for us and for them. It couldn't have worked better, actually, Ronit. I couldn't have planned it better. It's worked better than planned, put it that way. So yeah, kind of give them all those access points.
Awesome. Thank you so much for joining us and sharing your story, and look forward to seeing you in the flesh and in the real world. I heard a rumor that you might be in Dubai soon, so.
I will indeed, and I'll be in touch. And guys, look, thank you very much for having me. So you've had, Finja on with Monis, you've had Abby on. Obviously, we talked about Omer. But what you guys do for the region and the community in this pod, it's been great. It's appreciated.
Thank you, Dave.